Good afternoon. This is Business Live with Ian King. Now, the Chancellor has unveiled what he hopes will be some of the most significant pensions reforms in decades. Jeremy Hunt has reached what he called a compact with 9 of the UK's leading pension providers, including Legal & General and Aviva, to commit 5% of so-called default funds for defined contribution pension savers to unlisted equities by the end of the decade. The Chancellor believes the deal could unlock up to £50 billion worth of investment if all such UK pension providers follow suit.
The reforms that I'm announcing today for the average person could unlock an extra £1,000 a year on the value of their pension. And it does that by removing the barriers that currently stop British pension funds investing in some of our most promising, fastest growing companies like the company I'm at today. What happens at the moment is that these brilliant British companies are invested in by Canadian pension funds, Australian pension funds, but British pension funds find they can't. And so we're not forcing anyone to invest anywhere they don't want to invest, but we want to remove the barriers so that they can have a more balanced portfolio and therefore increase the returns to their own pension fund holders.
Well, Mr Hunt was speaking at the Mansion House, which is, of course, the official residence of the Lord Mayor of London, Nicholas Lyons, who had called for many of the measures the Chancellor outlined. I've been speaking with him.
Very much so, yes. I think it was a really wonderful example of how the long-term savings industry came together, working with the government and regulators to come up with a package that is really going to make a difference to pension savers and hopefully also to UK growth companies.
You did, of course, want an element of compulsion here, which the Chancellor has shied away from.
No, you challenged me on that one last time, and again, I pushed back. I'd always said that there are a range of ways to tackle this, and the best way is to try and do it voluntarily, and that's what we've got to here, which is terrific. That's the British way of doing things. So I think what we do want to see is a significant investment in unlisted equity. That will significantly enhance returns for pension savers. And by having the 9 largest players in the pension market representing 2/3 of DC pensions voluntarily saying that this is something that they agree to and will commit to, I think is a very strong signal.
You're not bothered that some of the major players in the industry, the likes of Fidelity, haven't signed up to this compact?
No, I mean, we went to the 9 largest players and said, and you know, there are going to be a lot of subsequent ones who will be follow-on ones. These are sort of founder signatories. At the end of the day, when you're trying to get a large number of private sector firms to form a compact, you have to sort of pick a sensible number.
Now, the Chancellor's also announced plans to potentially roll back on MiFID II, which, of course, oblige brokers to sell their research rather than bundle it in with other services. Is that a good idea? Look,
I think we need, if we're going to create a really vibrant equity culture, there are lots of things that we need to do. One of those things is to encourage very strong equity research. And MiFID II was an obstacle. It's not the only obstacle. At the end of the day, the decision that will really drive a step up in the quality of equity research, particularly around technology stocks, will be when investment banks feel that there's going to be a proper flow of IPOs that will justify spending the money on research. So that's what we've got to get to. This is a sort of a catalyst for changing the ecosystem.
Do you worry, though, that MiFID II, the damage has already been done? I mean, there's a real dearth of research around a lot of small-cap companies in particular now.
I think that we've got a way to travel, but you know, can we get there? Yes, we certainly can. But I think this is one of what will be a series of initiatives that will really help to shape London as a listing venue. That's really important. If we can stimulate London as a venue for equity trading and listing of stocks, then we're going to get that research.
How rapidly do you think these measures will have an impact?
I think it will. What we've consciously done is to say we want people to get to a 5% of DC pensions in unlisted equities by 2030, because they need to make that transition gradually. We're not going to be able to invest the money. I mean, we're talking about £50 billion by 2030 potentially, 5% of what we think will be in the DC market, which should be £1 trillion by 2030. So we need to. It'll take us a year to to put together a collective fund like the Future Growth Fund. You know, we've already got Legal and General, Aviva and M&G with the capability to do this, and they're already doing it. So there are some options out there, but we need significantly to change and enhance the scope of what we're doing.
Well, the so-called Mansion House Compact was part of a broader sweep of changes announced by the Chancellor to stimulate returns for pension savers and make the UK economy more productive. Other measures include allowing smaller defined benefit or so-called final salary pension schemes to merge, encouraging more local authority pension schemes to pool their assets and invest more in private equity, and introducing a so-called super fund regulatory regime. Well, joining me now to talk about this is the former Pensions Minister Steve Webb, now a partner at the Pensions and investment firm LCP. Steve, good to see you this afternoon. Let's start with these proposals for the PPF, the Like Both scheme. I mean, essentially, the government sees this as perhaps being allowed to take over schemes that haven't failed. Is that a good idea in your view?
So there's two very different pension protection fund ideas kicking around. So the Tony Blair Institute came up with this idea of saying you take the small schemes, who, as you say, wouldn't be in the PPF until the sponsor went bust, and you say there's ridiculous thousands and thousands of these tiny schemes, let's shove them all in one place. Where shall we put them? Pension protection fund, they've invested well over the years, that would somehow be better. And it looks good on paper. And then you think, well, hang on a minute, but are these funds well funded? In which case they'll probably go off to an insurer. So they're probably a bit underfunded. So they move to the PPF, still get all the pensions paid in full. So who's making up the shortfall? And I don't think we've got an answer to that question yet. So it looks neat. It's just like moving money from your current account to your joint account. But pensions didn't like that.
And isn't the problem, though, all these defined benefit schemes, they're all in runoff by definition. All they're trying to do is meet the liabilities that they're due to pay out in future. They're not necessarily going for out-and-out growth.
There's no incentive to it at the moment. And so the proposition that we've come up with is for the other end of the scale, the big, well-funded schemes. You know, you think of companies that are billions of pounds of schemes in surplus. You know, 7 years ago, took all these schemes together, they were £400 billion in deficit. On the same measure, they're £400 billion in surplus today. And the thinking, the regulations just hasn't caught up with this world of surplus. So, yeah, some will buy out. They'll go to an insurer, they'll write a cheque, job done. But if you've spent years painstakingly building up billions of pounds in pensions, why wouldn't you want the upside? Why do you want to hand it over to an insurer? So what we're suggesting is a change to the regime that would allow these firms to invest for growth, the pension schemes to invest for growth, with some safety underpinning for the member benefits, and then everybody benefits.
And that would be overseen by the PPF in your eyes?
That's right. So at the moment, the Pension Protection Fund is a lifeboat. So if the company goes bust, the PPF picks up 85 to 95% of the benefits, depending. What we're suggesting is a PPF super levy, an opt-in for well-funded schemes. The employer comes along, says, I'll pay a bit extra. The member benefits are then fully underpinned. The trustee can see the member benefits going to be paid, so the trustee can relax. And then you can invest for a bit more growth, not the 230 ADOC, but, you know, instead of having everything in gilts, a bit more growth. And then if that creates some surplus funds, the firm can have some of that, the DB members can have some of that, the younger workers can have some of that. You know, there's a bigger pie to carve up. But at the moment, we are wasting billions of pounds.
And you'd be happy with 5% of that being allocated to private equity or venture capital?
Well, the 5% is a DC thing. It's about a voluntary thing on the defined contribution side. If the trustees thought that was a sensible way of using the money, I wouldn't have a problem with that. I'm not a great fan of arbitrary figures. Yeah. But, you know, if they can invest a bit more for growth and that's part of the portfolio, why not?
Because that's the other interesting thing. I mean, while we're talking about DB schemes, I mean, Mr Hunt wants local authority pension schemes to invest 10% of their assets in this particular class. Is that a good idea?
Well, over the years, the good thing has been local government schemes coming together. I mean, it's incredible. We have a Devon pension scheme and a Cornwall pension scheme and a Somerset. You know, they're hard to think they need their own investment strategy. So bringing them together, I think, makes sense. I think there comes a point beyond which you say, well, why wouldn't the trustees do this anyway if it was a good idea? And to be fair, the government are trying to work out, well, are the trustees ill-informed? Are they risk-averse? You know, are there barriers? Fine, let's get rid of the barriers, but then let them choose the right things to invest in, not just pick a number.
I guess the advantage is, though, that these local authority schemes are ultimately underwritten by the government, so there is a bit of scope for a bit more risk-taking?
There is, and they're much more long-term, you know, because you're not worried that they're not going to be around tomorrow to stand behind them. So they are open. that are long-term, so they ought to be investing more for growth. So you can see why they should have a higher allocation, whether 10's the right number. I mean, there is an issue on the supply side of all of this as well. Plenty of trustees have said to me, we'd love to invest in this stuff. Where is it? What is it? You know, so some of these reviews last night are about the British Business Bank, for example, thinking about do they need another investment vehicle to matchmake between the schemes and the people who need investing.
And do you see these local government schemes coming together in the way that the Chancellor seems to want them to?
I think the government is so obsessed with consolidation and scale that they think 6, or I think that's how many there are at the moment, is too many. So I could see them pushing them further together.
Yeah, you're always taking on vested interests, though. You know, people are going to lose their jobs out of this. You know, it's a bit like merging police constabularies, I guess.
Well, that's what happened in the Netherlands. I mean, there was massive consolidation and the whole, the sector I'm in of consultancy shrank considerably because there were just far fewer schemes. So pension schemes shouldn't be a make-work for the industry. But there are risks. There does come a point where it can be too big, there's too much concentration of risk. And at the moment, the drive is entirely in one direction.
Worth making and Patrick Hosking made an excellent point in the Times today where he said Mr Hunt was making all sorts of claims for the returns that these private investments are going to make that you'd never be allowed to make if you were selling an insurance policy.
Yeah, I think they've been determined to link this kind of quite high-tech, complicated regulatory city stuff to real people and real voters, one dare say. So that's hence the £1,000 a year on your pension. But the language is very if this, then that. You know, if they got as good a return as the best schemes, then this would be the outcome. Not that it actually will be. Yeah. But I guess trying to make it real to people, because getting people to engage with pensions, as we know, is a bit of a challenge.
Yeah. But I mean, on the whole, how many marks out of 10 would you give the Chancellor for trying to at least give productivity a boost?
Yeah, I'd be in the 7 or 8 category because I think, although this is a bit of a blunderbuss, I still haven't read all the documents they published at 7 o'clock this morning, you know, got to do that tonight with a stiff drink. But, you know, some of these things will land, some of them will stimulate sectors that have struggled in the past. So I think they've tried to look holistically, and that's probably got to be a good thing.
All right, Steve, well, I'll let you get back to the documentation and your stiff drink. Good to see you, thank you. Some other stories for you now, and wages continue to grow at a record pace during the 3 months to May, maintaining pressure on the Bank of England to continue raising interest rates. The Office for National Statistics said that regular average pay, which excludes bonuses, grew at an annual rate of 7.3%. That was unchanged from the 3 months to the end of April. Well, private sector pay during the period rose by some 7.7%. That was the largest outside the pandemic period, while in the public sector it grew by 5.8%, which was the fastest pace since the period from September to November 2001. But the unemployment rate unexpectedly rose from 3.8% to 4%. Centrica said today it has struck a long-term sale and purchase agreement to buy 1 million tonnes a year of liquefied natural gas from the United States. The owner of British Gas said the $8 billion deal with Delphin Midstream, which will run for 15 years, marked an additional move by it to build further resilience in the UK's energy security. The company has already struck a 3-year supply agreement with the Norwegian company Equinor that will heat 4.5 million UK homes through to 2024, and it has reopened the Rough gas storage facility, which now provides half of the UK's total gas storage capacity. Centrica said today's agreement could provide enough energy to heat 5% of UK homes for 15 years. The commercial property firm British Land, whose assets include the Broadgate Centre in the city, the Meadowhall Shopping Centre in South Yorkshire and the Drake Circus Shopping Centre in Plymouth, insisted this morning that its business was continuing to build momentum despite the uncertain economic backdrop. The company, which is the largest direct owner and operator of retail parks in the UK, said that it leased just over 500,000 square feet of space during the 3 months to the end of June, and that a further 1.2 million square feet had been put under offer. British Land said its occupancy rate was 96% during the period. The shares are up by 1.75%. The average 2-year fixed mortgage rate has climbed above the level seen last year when financial markets were put into turmoil following the so-called mini-budget presented by the then-Chancellor, Kwasi Kwarteng. Rates had been steady earlier this year following the shock of Mr Kwarteng's proposals, but they've been moving upwards in the last few months on expectations that the Bank of England has much more work to do to bring down inflation. Well, figures released today by analysts Moneyfacts Compare showed the average 2-year fixed-rate mortgage now stands at 6.66%, up from 6.63% yesterday, and that is the highest it's been in 15 years. Meanwhile, the average 5-year fix now stands at 6.17%. That's up from 6.13% yesterday. There are now almost 300 fewer projects on the market than there were yesterday, as lenders predict another Bank of England rate increase. Joining me now to talk about this is Simon Gammon. He's founder and managing partner of the mortgage advisors and brokers, Knight Frank Finance. Simon, good to see you this afternoon. Are you seeing a lot of evidence of homeowners rushing to lock in mortgage rates?
Yeah, absolutely, especially in the last 6 weeks. I think everyone since the mini-budget, people have been moving, thinking rates are coming down, they've been waiting, and of course that hasn't been seen. Inflation has been stubborn, and so now with rates rising, people are having to act. They don't like the rates they're taking, but they're having to act, and we've seen a big spike.
So these are people that have come off a fix, they'd moved on to a floating rate in the hope that rates might start to calm down,
Yeah,
and
absolutely.
now they're moving.
So if you went back to sort of the tail end of the year, the beginning of this year, you know, a lot of the commentary coming out of the Bank of England, out of the government, was that inflation was under control, we were getting there, and of course that's proved not to be the case, and today's data proves that further. So we've now seen this shift of mortgage rates going up, and that's forcing people into action.
You haven't seen much evidence of people remortgaging, even though they don't have to immediately. Is there much of that going on?
I mean, I think at the moment people are just trying to find out what the best thing for them is to do. And that's what we're saying to everyone, is get yourself into the most informed position. Even if you're not coming to the end of your mortgage rate right now, understanding what it would be like if you were coming to the end of the rate is a good thing to be doing.
Now, the Treasury Committee had various lenders in front of them. I'm not sure what they were trying to find out. I mean, I know there's an argument about savings rates not being passed on as rapidly as they could be, but with mortgages, the lenders have no choice.
No, they don't. And actually, the margins that they usually have to play with have been eroded, and there's really very little margin in a mortgage right now for a lender.
Yeah, absolutely. Where are you seeing most people plumping for them when they're going for another fix?
2-year fix is by far the most popular for those that accept where the rates are. I think there's still a view that even though we're not where we wanted to be, this is a 12-month problem, an 18-month problem, and then by the end of the 2-year rate that they come off, the mortgage market might be looking a bit more promising. Yeah. So 2-year fix is the best.
And in the meantime, though, we are seeing fewer products available on the market. I mean, every day lenders seem to be pulling products. At what point do you become worried about the sort of scarcity in terms of availability?
I mean, it's a constant battle trying to keep up to date with the market, and you know, for a normal borrower on the high street, it's a very challenging place. Mortgage brokers are struggling with it too as well. It's a very fast-moving market. In terms of where we think the number of products are going, I think we could see a few more reductions in the number of products over the next month or two.
Really?
And particularly at the higher loan-to-value mortgages, which of course has an impact on first-time buyers.
Well, you've kind of preempted my next question because, I mean, all the lenders say to me, we've got plenty of credit available, we're still prepared to lend, we're looking to do business. Are you seeing evidence of lenders tightening their criteria?
Not so much tightening their criteria, but they're looking at the pricing and the availability of particularly those higher loan-to-value products. If you're looking at the property market, you might be thinking there's going to be a correction. We're already seeing house prices step back in certain regional areas, and overall the data shows a decline. So if you're a lender and you're looking at lending 95%, that's potentially a risk.
Yeah, absolutely.
And that's reflecting in the number of products.
I mean, it seems that buy-to-let mortgages, there is a bit of an availability situation here.
Definitely. I mean, buy-to-let mortgages have been really tough since the mini-budget. The way that they're calculated, the way that lenders assess how much you can afford against the rent of the property that you've got, with the interest rates the way they are, I mean, it's very difficult to remortgage.
I know you're a mortgage broker and advisor rather than an estate agent or anything like that, but I mean, this is presumably going to have an impact on house prices at some point.
Well, I think what we're seeing in the property market right now is there's the needs-based people acting, so those who have to sell for whatever their reasons are, family reasons, death, divorce, all those sort of things. And then there's potentially a more an opportunistic element to it as well, where people who have the means to buy are actually starting to look for a bargain.
Right, so you're seeing cash buyers out there then?
There are still cash buyers out there, yeah.
Right.
And it's an interesting place to watch.
Simon, got to leave it there. Good to see you this afternoon. Thank you.
Yep.
Well, the pound rose to a 15-month high against the US dollar after the wage inflation figures dropped at 7 o'clock this morning. Sterling has held on to much of those gains. It's a quarter of 1% higher right now against the greenback, $1.29 or so. It's also up by nearly 2/5 of 1% against the euro. The single currency, meanwhile, is off a 1/10 of 1% right now against the dollar. On the equity markets, well, I can tell you the markets in Europe have closed. They've all finished in positive territory. I don't know whether we can show you the prices there. Here they all are. So all of the main continental European indices in positive territory. Not so pretty a picture for the FTSE 100 this afternoon, though. There we go. Look at that. It's finished nearly a 1/10 of 1% higher or so. A lot of those big foreign currency earners have been weighing on the index, the healthcare stocks in particular. So a bit of a comeback there from the FTSE. It's been in negative territory for most of the session. And in terms of individual gainers, there aren't very many in the FTSE 100. Outside the FTSE, there's an awful lot more going on. The car parts maker Dowlais is off some 5.5% on Brokercom, and that was, of course, recently spun off from Melrose Industries. Meanwhile, Pennon Group, the owner of South West Water, its shares are off by just over 1%. That's on news that it's paying £85 million for 3 new renewable energy generation projects. And then stocks trading to the upside this afternoon when the house builder Galliford Try, look at that, it's up nearly 7.75%. That was following a trading update earlier on this morning. On Wall Street, I can tell you the S&P 500, the Nasdaq and the Dow have all opened higher this afternoon. Talking points, though, you can see Microsoft on the screen right now. It's trying to buy the games publisher Activision Blizzard, and its shares are up some 4.5%. That is after a US judge denied a request from the competition regulator there, the FTC, to halt its takeover by Microsoft. So Microsoft off by 2/3 of 1% there. Activision Blizzard more than 4.5% higher right now. Very, very dramatic development indeed concerning that very long-running takeover situation. As for the oil price, well, that edged higher earlier on this morning. It's been trading in a pretty tight range all day, but it's broken out this afternoon. A barrel of Brent crude will currently set you back $79.43 a barrel. That is ahead some 2.25%. Well, joining me this afternoon is the Chief Investment Officer for Charles Stanley. That's Patrick Farrell. Patrick, good to see you this afternoon. What's been catching your eye today on the markets? And not been many individual features to get excited about.
Well, I think, Ian, we've seen some of the more stimulus plans coming out of China earlier on this morning, and that got the market off on a pretty good start. But the pay numbers, as you mentioned, in the UK just continue to surprise on the upside. And the Bank of England certainly has some work to do, because what we're seeing is, there's just too much momentum behind some of the wage data that's coming through and how that's feeding through into the inflation numbers. So, the strong sterling is very much as a result of, some of the policy expectations and where peak rates are actually going to end up in the UK. But on the flip side, we had some consumer credit numbers come through from the US last night, and they were a lot weaker. So there's a double whammy effect in terms of the currency, because the US dollar has really come off on the back of, hopefully, that some of the policy initiatives are actually starting to slow consumer activity in the US.
And Patrick, of course, the real showstopper data-wise is the inflation numbers we get out of the US tomorrow.
Mm-hmm. And I think what we can expect is we've got a really big June 2022 number that's going to drop out of the series. So the actual headline rate should actually print in the low 3s. And a lot of questions that I get is the job done for the Fed? Being in that sort of 3% sort of range, maybe the Fed don't need to do too much more. But the unfortunate thing is, for the next 6 months, we've still got some very low numbers that are going to drop out of the series. So unfortunately, the inflation rate, the headline rate at least, is going to pop back up again. So it's not all good news at this point, but it's certainly going to be a win from a market perspective when we're looking at the number tonight.
If I've understood you correctly, Patrick, you're saying that even if we get a low print tomorrow, the Fed definitely can't declare mission accomplished yet.
I don't think they can. I think that the core inflation rate is still too high for their liking. and they continue to represent their inflation target at 2%. So even running at 3%, and if it pops back up to 3.5% later on towards the second half of the year, yeah, it's still going to represent a number that's too high for the Fed. So I do think that there is going to be more interest rate hikes coming down the pipeline, and I do think that the Fed will continue to talk tough in relation to some of the sort of rhetoric that they've been putting out.
Yeah, and in the meantime, Patrick, worth noting that move in the oil price this afternoon was quite dramatic. I mean, Brent crude nudging back towards $80 a barrel. It's been fairly quiet on the oil front lately, but it's a bit disquieting to see it back at these sort of levels.
Well, it's one of the key things that's helped inflation come down so quickly, particularly in the US, not so much here, but energy prices, fuel prices in particular, are below where they were at the start of the Ukraine war. So that's been a detractor from inflation, and that's pretty much the case right around the major markets. But what we need to be a little bit cautious about is if there is a re-acceleration in oil prices, that's going to unwind some of the detraction. So it's been one of the key mechanisms to actually have some of this disinflation that we've been seeing, not in the UK, but certainly in other parts of the world. But if it starts to re-accelerate, that becomes a bit more of a problem for a lot of the central banks around the world.
All right, Patrick, we have to leave it there, I'm afraid. Good to talk to you this afternoon. Thanks very much indeed for joining me.
Thanks very much, Ian.
That's it from me. I'm back again with Business Live tomorrow morning at 11:30 on Sky News. Do hope you can tune in for that. Thanks for joining me today. Cheerio.